Good evening. Welcome to part 2 of exit planning. My name is Stephen Beal. I'm the principal of Beal Business Brokers and Advisors, and we want to pick up where we left off and dive more deeply into some of the financial and tax issues that you'll face as you're looking to either transition or sell your business. I do want to give a disclaimer that this is not complete tax advice. We're going to touch on at a very high level on all the different tax issues, or some of the different tax issues that you will face if you're thinking of selling your business. But we strongly encourage you to talk to your financial planner and, of course, your accountant about the details and how they apply to you. So I've got to start with a second warning, which is everyone hates paying tax. So it's tempting as you run your business to do whatever you can to minimize the taxes you pay as you are running your business. The issue becomes if you are extremely aggressive, there's a number of different issues involved. One is the lower the profits on your business, the lower the value a buyer is going to assign to it. And as part of the sale process, we certainly point out to the buyer, well, the owner is deducting this or that or the other thing, or maybe the owner pays himself a low salary and takes out dividends or things like that. And some of those things, yes, we can adjust for and explain, and buyers will accept. Some of the things that are more difficult for buyers to believe or accept are things like certainly unrecorded cash transactions. If you've never declared that income, then don't expect the buyer to all of a sudden believe you that after 30 years you've actually had $100,000 a year extra in extra cash that was never recorded anywhere. So buyers just aren't going to believe that type of thing. And more importantly, or at least as importantly, is the banks aren't going to finance that. So if you have material amounts of unrecorded cash transactions, that will never be added to the value of your business because the buyer can't believe you, and the banks can't go beyond what they see on their tax returns. Some of the other things I'll call a bit more in the gray zone. So like say meals and entertainment, Jets tickets or other sporting events. Those things are a bit more in the gray zone and a bit more, bankers will look at it and say, okay, I understand that if you've got a couple $1,000s in expenses that are sort of gray zone type things. Other things to look at are related party transactions. Big one is things like if you own the business and you happen to own the real estate and you own the real estate in a related company. So you have two separate corporations. It's important to make sure as we're looking at the numbers to understand what the rent is that is being paid and what that rent should be. I mean, think, for example, if you sold the business, how much rent, but you kept the building, how much rent would you want to be paid? So you might be paying yourself less than fair market value, or in some situations, maybe more than fair market value. Typically, what we want to do is be able to understand what fair market value is so that we'd be able to get a clear picture on what the value of the business is versus the value of the real estate. If we have a distorted number in there in terms of what they're paying each other, it distorts both sides. Obviously, CRA is on guard for all these different things, and buyers just discount or just ignore any money that doesn't actually show up or can't be easily justified from the financial statements. So what we do is step one in terms of if you're looking to sell your business, step one is to determine what's the value of that business. And so we look at all these different things. So some of the things we just mentioned where we can adjust, again, things like cash, we really can't adjust for. Things that we can adjust for are, say, one-time expenses. So, for example, we just are hopefully at the tail end of this whole COVID-19 experience. So really probably for the next 5 years, when we analyze the value of businesses, we'll probably ignore 2020. I've seen some businesses where they've actually done well during COVID, but that's a one-time benefit for them. Other businesses, of course, have been negatively impacted, and will ignore that negative impact as well. And certainly all the government subsidies in there, all those things will sort of be stripped out as one-time issues. Similarly, if you have a year with unusually either high or low bad debts, we'll typically average those out or whatever, ignore them. Take a look at how you account for inventory. Different businesses account for it differently. We'll take a look at how that's done, and any non-operating expenses or revenue. So, so back to say my previous example of a business owner who owns the real estate in a separate corporation. Let's say he owns that real estate in his operating corporation, and he collects rent from other tenants in the building. So things like that are sort of different from the business, and those would be adjusted out. Once we've analyzed the numbers and have them in a cleaner, tidier format, then we take a look at what do similar businesses do in this industry, and we compare it to industry norms, and try and determine why your business is better than or worse than your competitors or your peers, just to better understand the business. Some of the tax issues to look at, and again, repeating my warning at the beginning, this is not a tax course. You will need to talk to your accountant and or your financial planner about your personal tax position. In general, when you're looking to sell a business, there's two broad ways of doing it. You can either sell the shares of the business or the assets of the business. And all I mean by that is, or a simple way of thinking of this is, who does the buyer write the check to? So if you as an individual own 100 shares or 100% of the shares of XYZ Corp, and a buyer comes along, if he's going to buy XYZ Corp, he's going to write to you personally a check to buy the shares from you. So the transaction is between you as an individual and the buyer, and you are giving him the entire corporation, the entire legal entity, warts and all. So there's issues there that we'll get into from your point of view and from his point of view. The alternative is a buyer may come along and say, I want to buy the operations of your business, all the assets inside that corporation, including things like name and goodwill and any contracts that you may have. But they're going to set up their own corporation, and they're not going to buy your corporation. And then they or their corporation is going to essentially be writing a check to your corporation, and the money goes into your corporation. So you are still left with that corporation and all the issues that are involved with that. So depending on whether it's a share sale or an asset sale, you need to look at things like accounts referred to as purification issues. One of the advantages of a sale of shares from here in Canada is we have a lifetime capital gains exemption of approximately $850,000. And I say approximately because it's indexed to inflation. So in 2020, it's around 852, if I remember correctly, and that will grow over time by the inflation rate. But it's only available to you as an individual. So if you have a holding company that owns your operating company, it doesn't work. If your operating company has too much cash, or it has unrelated assets, it has like a cottage or anything like that in there, you need to worry about that. So again, consult with your accountant about if your corporation qualifies for capital gains exemption purposes. The other thing you need to look at is certainly your personal capital gains level, but also capital gains inside the company. There's also a tax thing known as the CDA, which again, your accountant can explain to you. This is a good thing. It can help you save some taxes. Recapture is a bad thing. So again, in the scenario where the buyer comes along and buys the assets out of your corporation, if you think about it, all your equipment, you typically have written that down to probably a fairly low number, certainly lower than that equipment is worth. And so in a sale, you may have to pay tax on the sale of that equipment, and that's referred to recapture because you wrote all the value of that equipment down. You're now getting that money back, and the government will want their share of it. Certainly, if you do a wind down, you might have that similar issue. So if you sell off all your assets, you may wind up with taxes even on a wind down. You have to look at the GST implications on a sale, and again, your accountant can help you with that. And all these things have implications for the deal structure and how you want to look at potentially selling the business over time, and that would help defer gain. So rather than have a large gain in any one year, maybe you spread it over 3 or 4 or 5 years. For structuring, there's a million ways to structure the business. I just mentioned selling assets versus selling shares, so that's sort of the two main things to look at. Other potential things to add into a structure, there's something referred to as an earnout, where the buyer pays you over time. It could be a variable earnout, or it could be a fixed earnout. Fixed earnout is typically just referred to as a vendor take back or vendor take back financing, where you agree to sell your business for $10 million, and the buyer pays you a certain amount of cash on close. He borrows another portion, and then he pays you, say, 10% or $1 million over a 5-year window. So that could be, like I said, it could be a fixed number, or it could be dependent. The classic earnout is dependent on future outcomes, whether it's revenue or profits. A sale over time, again, that could be a similar type of thing where the person just buys in 10% over time. In part 1, I talked about a sale, a family sale or sale to management. Certainly with the family sale, it may make sense to sell 10% of the shares to your kids, 10% per year, so they sort of buy in slowly, and you cash out slowly. Partnership is also a possibility. Perhaps the buyer wants you around, and so maybe he buys 49% on day one, and then buys the rest over time, or maybe you stick around for longer. Obviously, if we're talking in situations where you do own the building, are you going to lease the building? There's also a possibility to lease the business. I've seen this in businesses that say a restaurant, like a business that has a lot of fixed assets. So the buyer could come along and rather than just pay cash on day one, they lease the business as a whole. Back to the share versus asset discussion. In general terms, again, because of our capital gains exemption here in Canada, sellers typically want to sell shares, and buyers typically want to buy assets, because some of the tax advantages the seller has in selling shares, the buyer loses by buying shares. So the buyers typically want to buy assets. So that's if you see the seller wants a capital gains exemption, and it's typically simpler for the seller, and for the buyer, it's sort of one agreement, one price, etc. The reasons a buyer may want to do a share purchase is if your company, certainly if it's large enough and has a lot of licenses and contracts and employees for that matter, an asset purchase, when these three things are there, is just that much more complicated. So essentially, you've got to lay off all your employees in an asset sale. They've got to rehire them, and they've got to renegotiate employee by employee, and so it's just that much more complicated in an asset purchase for a buyer to buy assets rather than shares. The good news for a buyer is typically because of the tax advantage for the seller, there may be a lower price or a slight discount that a seller can give in a share sale. In the flip side, the seller may want to sell assets in some situations where the seller has a lot of other assets in the corporation. So the corporation wouldn't even qualify even if the seller wanted to sell shares. So he might have all of his investments he left inside the corporation throughout the years, and so the tax hit on him to remove all that money would be so punitive. It just makes more sense for him to just sell the assets. For buyers, buyers need to understand that if they do buy shares, if they pay $1 million for those shares, there's no tax bump on that number, if you will. So there may be some restrictions on what you can depreciate as the buyer acquires the business. Now, on this $850,000 capital gain exemption, it is personal. So as I mentioned before, it does not apply to if you have an operating company that's owned by a holding company and then you own the holding company, even if you hold it through a trust, hold the holding company through a trust, selling the operating company may not be, you may not have access to the $850,000 capital gains. On the good news side, if the operating company is owned by, say, you and your spouse, or you and your spouse and your 2 or 3 or 5 kids, or a family trust, that $850,000 could be multiplied by basically the number of beneficiaries. So in a simple example, if you own the business 50-50 with your wife, each of you are entitled to $850,000 in capital gains exemption. So if you sell that business for up to $1.7 million, the full $1.7 million could be tax-free. So this again is a key thing to verify with your accountant or your lawyer. So as I mentioned in the first section, no free webinar would be complete without a sales pitch. So just a quick summary of what we do. We help people with business valuations. If you need to know what is the value of your business for any reason, tax planning, estate planning, death of a shareholder, divorce, any of the reasons, we can help assist with a formal written business valuation. We assist people to buy businesses. In our brokerage arm, we help people sell businesses or do mergers and acquisitions, so we assist with that. We help with family transitions and transactions, so if you're looking to sell to your kids, just be warned, you cannot you cannot give your business to your kids. You can't even sell for $1 because CRA will want to know that any transaction within a family is done at fair market value. So you can't give your business away to your kids. You have to at least charge a notional price that will provide the tax base for the business. Management transitions, if you're selling to your management and you need assistance on structuring or on valuation. And we also help with business plans. If you're looking to borrow money to grow, we assist with business plans, financing plans, and strategic plans. Thank you for taking the time to view this video. If you have any questions, feel free to email me or give me a call, or visit our website where you'll find other videos and other articles and blogs of interest. Thank you.